All right, folks, Dr. Cohen here, remaking the video I just made because the volume didn't work. Anyway, let's take a look. This is one of the tax returns, okay, from Chapter 5. I think most of you got the majority of this right, but let's just go through it. So the first thing, so we got some information here about the Workmans, right? They have a child. He's self-employed. She has a salary. So Dana earned $96,000 for a salary. Okay. So the key is, I think, to take these items and say, are they taxable or non-taxable? And then if they are taxable, where do they go? Okay. So we know that one, that's going to be like a W-2 salary. Then this one, she borrowed money from the company. Okay. So here's the issue. Notice she borrowed $12,000. If you remember from the lecture, anything over 10. And what they did here was they gave her a discount on the interest. Well, if they do that and it's over $10,000, that becomes income. Okay, so she paid $240 in interest. It should have been $720. So this $480 is going to be income. Now on this problem, they put it on the line with the W-2. I believe it should go on Schedule 1, but we'll take a look at it in a minute. Okay? How about the next one? Ryan got $2,000 in alimony and $4,500 in child support from his former spouse. They divorced in 2016. So Ryan was married before, but remember, 2018, 2019, that's when things switched. So this alimony, this is income. This child support, not income. Take care of the child. All right, then Ryan won. So this is Schedule 1 income. Then Ryan won $900 in cash prizes. Okay, Schedule 1 income. The Workman's got money from corporate bonds and municipal bonds. Well, we know the municipal bonds are non-taxable. The corporate bonds are definitely taxable, and they'll be on the 1040. Okay. They had 50 shares of ABC stock, and they paid a dividend of $1 a share. So they have dividend income of $50. Okay, taxable. Ryan's father passed away. He got cash. He got a baseball card collection. Got an insurance policy. None of that is taxable. It's taxable not as income, but under the estate tax. And this is well below the level for estate tax. Okay? Item H. Company spent a weekend in Atlantic City. Okay? They had gambling winnings of $1,200. All right, well, bottom line is you won $1,200. The government wants their money. Taxable income, Schedule 1. Okay? Next one. Diana received $400 cash, okay, for 10 years of continuous service. Now, this one's a little confusing. Normally, $400 is the threshold, but it cannot be cash. It has to be tangible personal property. I don't know what that means. Golf clubs, I don't know, a ring. But the problem is it's cash. That's going to count as income. And in this case, they put it as W-2 income. Again, I believe this should be Schedule 1, but I want to let you know how they did it. Okay? All right, next one. Diana was hit by a drunk driver. She got Workman's $6,000 disability insurance. Okay? Let me see. I got to get over here a little bit. There we go. Okay. DI paid the disability insurance premiums for Diana, but they were reported as compensation. Now, because they were reported as compensation, right, they were already taxed, so therefore the money from it is not taxed because the premium was taxed, okay? So no tax there. Now, the drunk driver was required to pay medical costs, emotional trauma, pain and suffering, not taxed. Now, $5,000 for punitive damages, absolutely taxed. That's on Schedule 1, and there's not a special line for it. You have to add it in. Okay? Now, she's going to get a $5,000 year-end bonus. Now, the key here is, okay, the question is constructive receipt. Okay, so DI located in Houston, Texas. Payroll processing's in Tampa, Florida. They put it in the mail on December 28th. Well, the problem is she doesn't have constructive receipt. Constructive receipt means she has access to it. So you might think this should be in the current year tax return, but it's going to be in the next year. Now, in the textbook, they give you an example where the company was local and somebody could go get the check, but they just didn't. That's different. Then you would have to count it. Okay? Right, Ryan, 10% owner in a subchapter S, they made $92,000. So 10% of that $92,000, that becomes income, Schedule 1 income for Ryan. All right, now Ryan's daycare, a couple things here. First, he had revenues of $35,000. Now, they mentioned customers owe him $3,000 at the end of the year. So the question is, what do you want to do with that, right? Well, the thing is here, they say they use the cash method of accounting. So this means nothing. He hasn't received it yet, okay? Small business, cash. So he's got $35,000. Then he's got supplies, utilities, rent, miscellaneous expenses, okay? Now, another kicker, customer gave him use of their vacation home worth $2,500 in exchange for daycare. Well, that's taxable. So now his $35,000 became $37,500. $37,500 minus all of those deductions turns out to be $15,000, Schedule 1 income. Okay? Now finally, Diana, employer, pays health insurance premium, $5,500, qualified plan. Again, remember, health insurance is one of those fringe benefits that fall under the non-taxable. Okay? So the first thing to do is kind of go down what's taxable, what's not. Okay? So let's take a look at the solution. Okay, hopefully all this stuff in here, you know what I mean, the name, all that kind of name, rank, serial number, hopefully you got all this right. Okay? I think you would. Okay? Now this one, the particular student that asked me about this was an issue. And to be honest with you, that $96,880, remember, she made $96,000. That was her salary. Okay? $96,000 was her salary. Now, that $400 she got for working there for 10 years, they put it in here. I believe it belongs on Schedule 1. Okay? It's not W-2 income. Okay? Or if it is, they would have already included it. But let's go with what the book is doing. So this would be, so plus 400. Then, okay, so now we're at 96.4. Then remember she had that loan. And on that loan, she got a discount. It was $12,000. It was over the $10,000 limit. So again, we have to put it in there. Another $480. That's where they got that number. Okay? Oops. Oop. Plus 12. What? What the heck happened? Anyway, let's see. 96,000 plus 400 plus 480. Boom. There we go. Okay, that's where they got that. All right. Now, let's take a look here. Here's the tax exempt from the municipal. There's the taxable bonds. There's the dividends they have, ordinary dividends, right? Regular domestic corporation, $50. Okay. Now, here's the Schedule 1 item, and then this gives you the total. Okay, so we got to go over to Schedule 1 and see all of those other items. Okay. So let's flip over to Schedule 1. Okay. So the first thing, if you take a look here, alimony received. There's a line for that. That's the $2,000 that Ryan got. Okay. Then his business income or loss. Remember, he made $35,000 plus the $2,500 that he got in exchange. That counts. Minus all those deductions, turns out to be $15,000. By the way, the account receivables are ignored because he's a cash basis client. Okay, a cash basis business. Okay. Next thing, rental real estate, S corporation partnerships, $9,200. Why? Ryan owns 10%. They made $92,000. He would get a K1 that would wind up going to this S corporation thing here, $9,200. Okay. There's the money they won in Atlantic City. Okay. Here's the bingo prize that Ryan won. And then here, this is the damages. Remember, just the damages from that accident, okay? Medical, pain and suffering, not, but anything that's punitive, and they separate it that way, taxable. So you got $33,300, right? And if you go back over here, we're going to go back over the 1040. That follows through over here, $33,300. There is their total income. All right, folks, I hope that helps you out. I know it's a little confusing sometimes, but key is look at each item, taxable or not taxable, and why. And then it becomes a lot easier, okay? Don't try to do it as you go. I would suggest taking the information first and making your decision. All right, folks, I hope that helps. Talk to you soon.